But thank you all for coming. We've got a good night for you here, and I'll be introducing our guest speaker here shortly. Let's see if this thing works. Okay, good. Welcome. Yay, everybody clap. There you go. Thank you. That way I can feel important. That's all it really is. I got to stroke my ego a little bit. Again, let's go to the next slide. Our agenda, we've got our guest speaker. We've got 2 investment opportunities. We're only going to be real brief on those. And also tell you about everything that's gone on this year. We've actually, surprising how much money we paid out this year. So I'm very thrilled about that. First, real quick, our team. We've got Brian Hawley in the back. Who doesn't know Brian? Okay, you got to meet Brian if he's here. Dillard, right here, eating. Raise your hand, Dillard. Now, he is our controller. He's the numbers guy. He's the one that gets all your reports out. Absolutely great. He's the one that takes care of all that. Who else do we have in here? Anand? Anand's right here, and he's one of our co-sponsors, and he sold his stand up for a second wave. Who is in Anand's deals? All right, you happy with him? Yeah, well, I noticed you're pretty far away, so I didn't know. And Reggie?
Yes.
Reggie, where are you? Standing up right there. Reggie, we sold his deal this year too. Our first co-sponsor, and got that one done. And I think that's it. Is there any more of the team in here? Julian. Can't forget Julian.
I didn't sell my property.
You didn't sell your property? No, you're the buying side. You're the buying side. Well, I want to introduce Charlie Dombeck. I'm going to tell you first and foremost, I paid $10,000 for his advice. Okay? Yeah, look at her laugh. Sucker. No. And I walked out of our meeting, our consultation on that, absolutely thrilled and excited about all of the potential benefits that you can get, especially on saving on taxes and asset protection, et cetera. So Charlie's going to go through his presentation. So everybody welcome up Charlie.
It's great to be here. Thank you very much for coming out tonight on election night. I am a Dallas resident. I live in Keller and work out of South Lake. A little bit about me before we get started with the nuts and bolts of my presentation. I've been a practicing CPA for nearly 30 years. I started in the accounting industry with Ernst & Young back in the 1980s and spent most of my life in and out of public accounting. And about 20 years ago, I formed my own CPA firm, really as a result of observations that I made as a practicing CPA relative to how clients got served by their accounting professionals. And what I observed is that most CPAs are good at telling the story. We tell you how much money you made, how much you owe, when and where to file your taxes, and oftentimes how to write some pretty large checks at the last minute when you least expect it. So I really formed my own CPA firm for the sole purpose of helping clients recover dollars that they unnecessarily pay in the form of state and federal income taxes. And I'm going to touch on a number of things that are happening from a political perspective, a number of things that are happening in terms of what can we expect with 87,000 new IRS agents, what are the red flags, and how can you ultimately control the cost of taxation. A little bit about me personally. These are my 2 beautiful daughters, Kendall and Taylor. A lot of times I talk about how can we integrate structures in our life that add to protection, right? How do we protect ourselves from frivolous lawsuits and things that come up in our lives? And one of the things I found, not only as a father, but also as a practicing CPA, children often create massive havoc in your life, and that certainly did not escape my family. And I'll tell one quick story about my 2 daughters. The black-haired daughter on the left is Kendall, and the younger daughter is Taylor on the right. And this is one of my best days of my life when I got to give my older daughter away to another man to care for besides myself when she got married, actually. But when Kendall was 17 and Taylor was 14, they both worked at the same restaurant called the Whaling Company in Williamsburg, Virginia, about a mile outside of the neighborhood we lived in. Happened to be a Friday afternoon. It was a day that Kendall was scheduled to work. And Taylor, unfortunately, was not scheduled, but she wanted to get her paycheck. And as usual, Kendall was about 15 minutes late leaving our neighborhood to get to the restaurant where she worked. And she had a Toyota Celica that I bought them to get to and from work. And she takes Taylor, the younger daughter, in tow with her, gets to the restaurant, and she says, "Oh, I've got to drive Taylor back home after she picks her paycheck up. And she goes, the supervisor goes, no, you can't drive your daughter back home, your sister back home. We don't have enough time. You're 15 minutes late already. And so in her infinite wisdom, she determined it was acceptable for the 14-year-old with no driver's license and no previous experience to drive back home. So she gets in the car, drives home, and gets to the driveway successfully. But instead of pulling into the driveway, she drives next door and picks up the 14-year-old cute boy that lives next door. And we live in a horseshoe-shaped cul-de-sac, and she gets in the car, and the first thing she does is unfortunately not pay attention to the steering wheel, but actually starts playing with the radio, gets to the bend of the horseshoe, and there's a wooden guardrail, 6x6 post that kind of roll up to the ground. She goes right up the post, and I get a phone call from our neighborhood security. Mr. Donbeck, you need to come pick up the Toyota Celica that is upside down, up against a tree in the Williams front yard. And the good news is no one got hurt, but I will tell you, umbrella insurance is the cheapest form of asset protection, and everyone should have it. They both turned out to be wonderful, wonderful grown women. The youngest, who's the mischievous one of both of them, ended up getting a PhD in psychology. But my son here on the right, Max, is the youngest of all three, but he figured out life very early. He didn't go to college. Said, Dad, I've watched my two daughters go to college and incur massive amounts of debt. Instead, he became a real estate investor at a very young age and makes more money and has accumulated more money at 30 years old than both of the two combined, and has a net worth of well over 7 figures. I have been nice enough to finance his acquisitions, but he lives in Port Charlotte, Florida, sustained a bunch of damage to his portfolio, but has been really successful, never having had a college education, has done great as a real estate investor. So that's a little bit about me and my family. What I'm going to talk about tonight is how can I help you grow your wealth rapidly? I am what I call a wealth architect, and I focus on a couple of critical areas in my client's life that makes a difference in terms of how much and how fast your wealth grows. And what I'm going to share with you comes from observations I have made simply by being a practicing CPA and having counted people's wealth for a career. And what I have found is there's really 4 factors that determine how much and how fast you grow your wealth. How much you make, how much you save, how much you pay in taxes, and how well your investments perform. And here's what I know. 80% of your ability to grow your wealth rapidly is dependent upon 2 of the 4 factors: how much you pay in taxes and how well your investments perform. So my role is to help you find investments that improve performance, and how I can help you recover dollars that you're unnecessarily paying in the form of state and federal income taxes. I'm not going to talk a lot about the investment performance because you're at the right place. We all know what real estate does in our financial lives. I'm going to talk about what we can do today to control the cost of taxation.
You don't have to stop.
The problem in the accounting industry is most accountants are simply historians. We look back. Most accountants are very, very busy during January to April. My tax season is between October and the end of the year, because between now and the end of the year is when I can make strategic decisions and make changes in your life that ultimately reduce what you pay. I am a cost recovery center, and that is the type of accountant that you need in your financial life. Most accountants simply prepare tax returns. I get paid very high margins for doing debit and credit work, and frankly, if you're good at what you do, you can occupy a 14 to 16 hour day year-round just preparing tax returns, and I've done that. I've done tens of thousands of tax returns in my life, but I haven't prepared a tax return in the last 10 years, and I will never again. I help people save money, as simple as that. This is an observation in an email I got from a client. This is 2019. This is a guy that came to me in December, and it illustrates the problem in the accounting industry. And this is an email I got just kind of telling the story of the problems he was having. This is someone that came to me in December needing a tax strategy because his accountant wasn't serving him. This is from the accountant Bruce. I've completely eliminated his last name. I hope you don't have him as your accountant. And it's from Josh, who owned a business with his brother. And here's the email from the accountant. Attached is a spreadsheet with calculations of how much you and Justin should pay in taxes before the end of the year so you have sufficient withholding to protect yourself from penalties. The important amounts are the state and federal withholding. Attached are projected tax returns showing that the estimates that you'll have to pay from the pass-through income from your company will result in about $350,000 in income. You will each owe around $120,000 in combined state and federal income taxes, which will be due in April. Any questions, please call. This is called tax planning. That's called, in my mind, tax projecting. The reality is this is December 8th. So what did we do? We came in, we implemented a number of things between the 8th of December and the end of the year, and we saved about 30% on his tax returns, and he became a lifelong client. This is what you don't want. Why are taxes so important? The reason why taxes are so important is because they take a tremendous amount of purchasing power out of your life from an investment perspective. And ultimately, it creates a situation where it takes a lot longer to reach your financial independence goals. This is an illustration, assuming I can place $500,000 of capital into an investment and I can earn an 18% average annual rate of return. And I'm sure you've done that with all the things that Darwin does here. This strategy assumes that as a good accountant, I can keep that income off the 1040. And the reality is, with proper planning, I can keep most of your investment income off of your 1040 during years where you have high active income. If I can do that, and I'm paying tax at about 35%, at the end of the first year, I have $31,500 of additional accumulated wealth on a $500,000 investment earning 18% per year. By year 5, that grows to almost $600,000. So I have as much in tax savings as I do from the original capital I place into the investment, just after 5 years. By year 10, it's 1.1. By year 15, it's 3.3. So how does this help you? What we're going to do with tax planning is we're going to compound dollars in our investment strategies that we would normally have paid out in state and federal income taxes. That is the message, and that is the value. Most people can live a lifetime after 10 to 15 years just off the tax savings. This is ever important stuff. And it hasn't been more important than what we've dealt with from proposals that have come out from our administration. Look, the Biden administration has unsuccessfully been able to change the Internal Revenue Code over the last 2 years. They've tried 4 times. The wealth tax. All of these changes that ultimately would have represented changes that we haven't seen in generations that would have affected everyone in this room. Most of the tax changes recently have been targeted to the ultra wealthy. Many of them want to target things that I use every day in every person's financial life, which is IRAs and Roth IRAs and creating tax-free wealth. They want to eliminate the ability for affluent Americans to use a Roth IRA to create tax-free wealth. And there are clients in here of mine that I see that we have strategies in place that accelerate the way we grow tax-free wealth. That's an important part of the planning. The biggest issue we are all contending with now is the $80 billion investment in the IRS. Hopefully, we get a successful result tonight in the midterm elections and we can overturn some of this legislation, but the bottom line is it's going to take a presidential signature to change that legislation. This is an article that came out in April. The IRS is the key to the Biden agenda, and it absolutely is. Think about it. The Biden administration has tried to change the code to create more revenue. None of that legislation has passed. So instead, they say, I'm going to invest $80 billion in creating an army of accounting police. Every dollar the IRS spends in enforcement, they get 5 back. So this is a way to increase tax revenues without making substantial changes to the tax code. And we are going to see a massive increase in audits. And the reality is, in my practice with over 2,000 clients, I had 2 audits in the last 2 years, both no changes. The IRS has been decimated from a workforce and a funding perspective. It's the size of what it was in 1957 when our economy was a seventh of the size it is today. This is a book that lists every form and every line item that gets audited. It's called the IRS Data Book. It's an encyclopedia of statistics. I am probably one of the few bald accountants that reads this stupid book every year. But what comes out of this is the ability for me to audit-proof my clients' tax returns. And here's what I know. There are two types of audits. There's field audits and correspondence audits. Correspondence audits are when you get a notice in the mail from the IRS saying there's a change or you owe some money. I don't care about those. Those are easy to resolve. What I care about is when they want you to come to their office and prove certain deductions and review certain records and prove the gross receipts that you earn from your businesses or your investments. Those are the things that are going to increase substantially under new legislation. Here's what I know. There are certain forms that when you file, income on these forms are what we call an audit magnet. The first one is Schedule C. So that's the form that you use to report sole proprietorship income, independent contractor income. It is the most highly audited form of all of the forms. In fact, if you have over $100,000 in gross receipts, you got a 4% chance of being selected for audit, compared to the average of 0.23%. You use this form, I can guarantee you're going to get audited. However, if I move that activity to an S corporation, my audit incidence drops to 0.4%. That's a massive reduction in audit exposure. If I have rental income or passive investments or syndications that are being reported on Schedule E, right? 1.17%. That's going to go up. If I move that to a partnership tax return, it drops to 0.4%. Entity structures, number one, allow us to reduce the chances of being selected for audit. That's step one. Entity structures also provide us a basis to reduce the cost of taxation when used properly in your financial life. And this is just the surface. I'm going to come back and I'm going to spend a whole day with the group and I'm going to go over every red flag, every line item, and I'm going to tell you what things are going to get you under the radar of the IRS. And this is just scratching the surface. Entities reduce your chances of being selected for audit. What are your audit proofing kind of rules of thumb? Don't file your taxes late. What does that mean? Don't file after the October 15th deadline. Your chances of being selected for audit go way up. 25-fold increase in audit selection when you file late. Paying taxes late. There is the collection division of the IRS and there's the audit division of the IRS. If you go to an IRS service center, they're divided. One on one side of the room, one on the other side of the room. If you have back taxes and you haven't solved those issues and you get notices and you don't pay your taxes on time, guess what happens? The collection division of the IRS walks over to the other side of the room. This is probably a return you should take a look at. Matching issues, when you get an issue where something like a 1099 or a K1 doesn't match up, that creates a correspondence audit. We want to respond to those issues very quickly. There are ratio analysis. So I practiced with a former group manager from the IRS, a guy named Keith Craig, that managed the Eastern District of Virginia. His wife was a district director of the IRS. He's an absolute magician, but I know the underpinnings of the IRS scoring system in terms of how the IRS scores a tax return for potential audit, and ultimately for the possibility of collecting additional revenue. And when I come back, I'll spend a lot of time going through what ratios do you have to be concerned with as a taxpayer. How do we control the cost of taxation? My track record over a period of years is, on average, if you haven't got proactive advice, in general, I should be able to save you about 30% on your taxes. How do I do that? It's not rocket science. It's looking really at three things. What entity structures fit favorably in your financial life? I've already illustrated that entity structures, when properly used, reduce your chances of being selected for audit. Each entity type, whether it's an LLC, a partnership, or a corporation, has unique tax attributes. What I do as a planner is simply use those tax attributes favorably in what's happening in your financial lives. Every person has different issues and needs, but ultimately the ability to control taxation starts with the proper use of entity structures. How do you take money out of your business? How do you take money out of your investments? How you pay yourself from either an investment or your business has major tax implications. So when I work with my clients, we engineer strategies that ultimately allow you to take money out of your businesses and your investments in a tax-efficient manner. And then lastly, there are a plethora of what I would call executive level fringe benefit expenses. Most people pay for many of these things with after-tax dollars. How can we engineer strategies that ultimately allow you to pay for certain things with a pre rather than post-tax dollar? Going through this planning process, ultimately you lower your tax liability. You end up increasing the level of protection in your life for the underlying financial equity you have, and you end up lowering your chances of being selected for audit. That's what happens when you go through this tax mitigation exercise. I talked about entity structures. The basic entity structuring recommendations are as follows, and I'll spend several hours on this topic when I come back. I like to use flow-through partnership structures for investment assets. Those are assets that you own in syndications. Those are hard assets that you own in real estate. They're called holding companies. They should be structured as partnership limited liability companies. Why? One is, if I have 10 or 15 investments in a multiple syndications, I'm going to get 10 or 15 K1s. And I'm going to have a very busy Schedule E. If I have them in one holding company, I reduce those 10 or 15 entries on Schedule E to one entry. Partnerships allow me the ability to fund retirement accounts and other vehicles, even from passive activities. You can't do that if all of that income drops on Schedule E. So the partnership structure gives me the ability to take passive investment and do creative things with that income and ultimately reduce the cost of taxation. Partnerships offer high levels of legal protection at ultra low administrative cost. All the asset protection attorneys in the world, they want to make sure that you have lots of entities. Well, you don't really need very many entities, you need a couple. A partnership structure benefits from a legal theory known as a charging order. Someone sues you. My daughter gets in a car accident and someone gets hurt, I get sued. Maybe that's a policy limits claim. Now my financial equity is at risk. What happens if someone is successful in getting a lien against me? Anything that I own in a partnership structure is not available to a claim against me individually. The most that a person with a charging order against a partnership structure is to get the economic distributions that you elect to make. And if you write the operating agreement in a way, you create poison pills. Well, maybe the charging order recipient gets stuck with the tax liability. So partnership structures are ideal as holding companies for real estate you own and passive investments that you own. Generally, we separate those. A safe assets holding company, a risky assets holding company. And that structure provides the basis to clean up your 1040 from an audit perspective and give us the ability to do creative things like maybe pay management fees out, run certain types of expenses through there, and actually fund qualified retirement plans. C corporations, I love a C corporation as an entity that has very unique tax benefits. And the benefit of a C corporation was enhanced by the Trump administration. Most publicly traded companies operate as C corporations. They file and pay taxes at their own rate. The marginal rate of taxation was dropped down from 43% to 21% by the Trump administration to make us more competitive globally with other tax regimes. The result was there was a massive redistribution of wealth back into the U.S. from companies that had offshore structures just to eliminate the 43% corporate tax the U.S. had. One of the best pieces of legislation I've seen out of a presidential administration since I've been practicing as a CPA. But I like to use this in my clients' lives because I can take advantage of that 21% rate. What happens if I have a capital event that is subject to ordinary income and I got to pay tax at a 35 to 40% rate? Well, maybe I can upstream some income into this structure, pay tax at a 21%, and if I'm clever, this is the entity that, from a codified IRS perspective, allows me to pay for all of my fringe benefit expenses with pre rather than post-tax dollars. Out-of-pocket healthcare costs, travel, entertainment, vehicles, dependent care, tuition reimbursement. There's a whole list of these things. So you bring income into here, you wash out most of that income with fringe benefit expenses, and maybe leave a little bit that's subject to a 21 versus a 39% rate. So this is how entities make a big difference in your financial life. Ultimately, when I'm engineering a tax strategy, I like to create 3 pools of wealth. Most people I work with, when they come to me, they have an after-tax pool of wealth. Wealth they've created from investments they've made with previously taxed dollars. Most people have IRAs and 401ks, which are tax deferred. Most people don't do a very good job of creating tax-free wealth. Why? Because most of us here make too much money to be able to fund a Roth IRA and create tax-free wealth. Well, there are creative ways that we can ultimately grow a tax-free bucket of wealth. Why is that so important? Later on in life, when I stop working and I want to live purely off of passive income, I fill up the low-rate tax brackets with income from after-tax and tax-deferred buckets, which is taxed currently. When my marginal rate of taxation starts to get into the 20% range, if I've done my job well, I start pulling money out of my tax-free bucket. So later on in life, I'm able to substantially boost the amount of passive income that you have during your retirement years by allowing you to pull tax-free income out of a bucket of wealth that we've created. How do we do this? It's a bit complicated, but it's no different than what Peter Thiel did. How many of you know Peter Thiel? He's the founder of PayPal. He funded a very small Roth IRA, and then he used that Roth IRA to buy stock in PayPal when he started that business in his house or his garage. I think it was $1,700. And it bought $1.7 million of shares in PayPal. So his Roth owned PayPal when he started it. PayPal went public through an IPO and went to $50 a share. His net worth in the company inside his IRA quickly grew to $50 million and today is a multi-billion-dollar Roth IRA. Now the Biden administration wants to close this loophole, and they've tried already to create legislation that would prevent almost every one of us in this room from being able to do so. But the good news is they were unsuccessful, and we can use a similar strategy to this to supercharge our Roth IRA. It's called a preferred LLC. How many of you have self-directed retirement accounts in here? Several. Self-directed retirement accounts allow you to have control over the investment decisions with your retirement dollars, and you can buy alternative assets, of course, including real estate, with these dollars. This is an illustration assuming I have $1 million in self-directed retirement accounts. What we do is we form a limited liability company that is owned by 2 retirement accounts. One is a regular IRA. The second is a Roth IRA. This is a partnership limited liability company with 2 classes of ownership. Think about buying into a syndication. You buy A-class shares. Darwin, when he puts together a syndication, he's the B-class owner. Well, in this structure, the traditional IRA comes in and buys an A-class share, and your Roth IRA comes in and buys a B-class share. I'm assuming we can earn 18% per annum, and I've got $1 million of capital between my traditional and my Roth IRA. 900 in my traditional and 100,000 in my Roth. The way this entity works is very much like private equity. The traditional IRA receives a fixed preferred risk-free rate of return. They're concerned about fixed income. They're concerned about having capital there at retirement. So they don't want to take a lot of risk. So your traditional IRA only grows by 4% per annum. It gets a fixed preferred rate of return. The excess rate of return flows to the Class B Roth IRA member. So think about this. And the way we set this up is typically 90% of the capital comes in from your traditional and 10% of your capital comes in from the Roth. And typically we fund the Roth with a conversion, which everyone's allowed to do. Assuming I can earn 18% in year one on $1 million of capital, I'm going to earn $180,000. 4% of my rate of return, or $40,000, goes to my traditional IRA. So at the end of year one, I've got $940,000 in my traditional IRA. The excess earnings, $180,000 less the $40,000 that went to the traditional, goes to my Roth. So at the end of year one, I took a Roth IRA with $100,000 and grew it to $240,000. By year 10, I've got $3.3 million in a Roth IRA. If you have high-performing investments and the access to investments that perform much better than stocks, bonds, mutual funds, and ETFs, this is a brilliant wealth accumulation strategy and allows you to grow a tax-free bucket of wealth. And it works like magic. And it ultimately substantially increases the amount of cash flow you have later on in life. What else can I do in terms of growing tax-free wealth? This is what I call the holy grail of tax planning. It's called private placement life insurance. Most life insurance contracts you purchase with cash, right? You pay a premium, and if it's a permanent life insurance contract or whole life, you fund that policy with a cash contribution and you have cash that builds up in the contract. The benefit of life insurance is there's a huge industry that has done a lot of work over generations to create unique tax benefits in the code that benefit the life insurance industry. And here are the major benefits. Any money that the life insurance contract earns, whether it's a capital gain or ordinary income, is not taxed. So when assets are in a life insurance contract, that life insurance contract never pays tax on its growth. Problem with most life insurance contracts is they're sold by Lincoln Financial or Mass Mutual and they grow at 3% per year. So ultimately the investment side of the contract performs very poorly. With private placement life insurance, however, you can fund a life insurance contract with alternative investments. What does that mean? I can put a real estate asset in there. I can put a share of a syndication in there. I can put cryptocurrency in there. I can put private equity shareholdings and carried interest into a life insurance contract. Darwin is in the process of implementing this in his financial life. So now I take things that have the ability to have a substantial amount of appreciation and I fund a life insurance contract. And I'm putting assets into a life insurance contract that have the ability to earn 18% or more per annum. Now I'm getting a massive buildup tax-free in my life insurance contract. 10 years down the line, I'm done. I don't need to do anything else. I want to take income from my investments. Here's the beauty of the life insurance contract. You can borrow money out of your life insurance contract tax-free. So what have I done? I basically created an alternative structure to the Roth IRA acceleration strategy that creates tax-free wealth. Most people have no clue that this type of plan even exists. Now to fund this, you have to have a minimum amount of net worth, but this is a brilliant strategy for clients that have significant capital events on highly appreciated assets. And this is something that is available to every American. There's lots more that I could spend time telling you about the code and things that we can do from a tax planning perspective. I've literally just touched on the surface. Kind of wanted to give you a precursor of what spending a day would look like, where I have the opportunity to go through individual situations and provide very specific advice. Maybe we have a few minutes for a couple questions, but I think Darwin has planned for me to come back for a day and spend kind of a day with you, educating you about how can we actually implement some of these things in your life. Matt is here. He's a client of mine, and we've done a lot of this structuring in his life, and I suspect his Roth IRA has grown pretty well over the last 12 to 18 months since we've been working together. So I encourage you to talk to clients that I've worked with and look forward to the opportunity to help everyone with the things that I have done well and learned over a career of work as a practicing CPA. Any quick questions? Yes.
Test. Yeah, if you'll let me bring a mic to you, if you don't mind, so everybody online can hear as well, please. Got to talk right into it.
All right. Hi. My question is on the preferred LLC, and we've done similar with that and invested in real estate, but are you allowed to use non-IRA, non-Roth money inside that LLC, or can you not mix them?
You can't really mix in that LLC non-retirement plan assets. Now, you can use 401ks. So I use 401ks a lot for real estate investors, especially if there's debt financed income, because the 401k avoids the UBIT tax. But you can use cash balance plans, 401ks, and traditional IRAs, simples, and things like that. But you cannot commingle in personal assets. If you're looking to fund a deal with a preferred LLC and personal assets, there is a way to structure that where the personal assets can come into the investment separate and distinct from the preferred LLC.
Gotcha. Thank you.
Mm-hmm. Yes?
How much money can one take out of the retirement account?
Let us bring you a mic, please.
We want the people online to be able to.
How much money, is there a limit as to how much
There's-
one can
there-
take out? Can you take half of your retirement account and invest it?
So you can take all of your retirement plan assets and roll them to a self-directed account tax-free, okay? And you can invest those dollars the way that you want to, and you're not limited to buying stocks, bonds, mutual funds, and ETFs like you are in a traditional retirement account, say managed by a Schwab or a Morgan Stanley. There's no limit in what you can roll over. Now, if you have a plan with an existing employer, there are potentially some in-service restrictions, which I have a way of getting around as well. But if your money is in a regular retirement account, you have complete flexibility in unlocking those dollars. Yes.
So what is the difference between the SDIRA and this preferred LLC?
So the preferred LLC is simply an entity that is owned by self-directed retirement accounts. So if you have a self-directed retirement account, typically that is with an IRA custodian. What we do is create an add-on to the custodial relationship that you have. We form a limited liability company that is simply owned by your self-directed retirement accounts, that is funded from your custodian, that you have checkbook level control over. So it's no different than you buying a syndication through your retirement account. You're just buying shares in an entity that gives you some unique tax planning benefits and the ability to accelerate wealth in a Roth IRA.
Any questions? Here you go.
Yes.
I have one more. So my wife and I are using IRAs in a checkbook manner. I don't know that it's necessarily preferred.
Probably not, but okay. But I like the fact that you have checkbook level control. It makes things a lot easier in terms of working with a custodian.
And using real estate inside that to accomplish the same type of goals. My question is, has that been tested with the IRS, the checkbook level? Because when we got into that about 4 years ago, It was brand new. It was.
The Checkbook Control LLC has been around for at least 15 years, okay? And Swanson versus Commissioner is the leading tax case on that issue. And here's the rule of thumb. The rule of thumb is that if you purchase newly issued shares in a pristine LLC that has not been used for any other purpose, then that is allowable and is not a prohibited transaction. And the landmark case is Swanson versus Commissioner that kind of codifies that rule. And of course the IRS would like to eliminate this ability, but it's been tested in tax court, and you can have checkbook level control. The key is making sure that you don't enter into a prohibited transaction, that you don't buy shares from yourself.
Thank you.
Mm-hmm.
Anything else?
Anything else? Question? Here you go. I got Brian behind you.
Hey, quick question on the private placement life insurance. You'd mentioned that the gains that occur in the life insurance are tax free. Is there like an overfunding limit though if you're like winning a lot?
No, there is no overfunding limit. And the way that they get around sort of the funding limits in terms of the buildup of the cash value is the actual insurance component to the plan is based upon a group of pension lives of older people. And so you're actually getting a pool of multiple lives that don't limit your ability, number one, to fund the life insurance contract, number two, to have any health issues that would prevent you from having a life insurance contract. So even if you are not insurable from a regular life insurance perspective, you can use this strategy because you're not underwritten individually. The underwriting occurs in a pool of pension lives. So that is how the policy works from a funding perspective, from initial contributions as well as accumulation. So no restrictions.
You said that there was a funding floor to get into private placement insurance, that you had to have a certain amount of wealth. What is that?
It really depends, okay? On one is how much appreciation do you have that you're expecting to earn from a specific investment. I would say $5 to $7 million is kind of the threshold where this starts to make sense. Or for a lot of people that have substantially appreciated investments in private placements and stock options and things like that, where you're going to have a big capital event or a carried interest in a business, this is a brilliant strategy to really mitigate the costs of those big events that happen oftentimes in our lives.
Quick question. For the preferred LLC, can you have a joint LLC with your spouse
Yes,
with
you
retirement
can.
account?
Yes, you can.
So you can have like a 2 Roth account.
Yep,
Two
we have
traditional-
several clients that have exactly what you're describing, 2 Roth IRAs and 2 traditional
within
IRAs.
one LLC.
In one LLC.
So you can commingle the amounts.
You can, yep.
Wow.
As
Great.
long as you're buying newly issued shares, right? And when we form these things, we set them up that way. So you're buying newly issued shares. You're not selling shares from one IRA to another.
Okay, great. Thank you.
Can we use a real life example? You remember my stuff off the top of your head? No pressure. Roughly.
No, I don't remember your actual IRA balances.
No. I don't have any IRA
No,
balances.
but what I will tell you is we're doing several things in his financial life. One is the private placement life insurance. He has a lot of carried interest in a lot of these private equity deals that you participate in, and major capital events, one of which happened last year with about a $2.5 million gain. And what can I do to mitigate that cost? Well, it's very difficult after the fact. So we are taking investments that have the potential for significant gain, and we're going to fund about $10 million into a life insurance contract for him. So all of the gain on those assets are going to mature in a tax-free environment. We're also setting up structures that he can fund from his operating company, because he has an operating company that generates ordinary income, and we're going to fund cash balance pension plans and these 401ks and these Roths, and we're going to create the preferred LLC for him and his wife as well. So he'll have that structure in place. Those are the major things that we're doing in Darwin's life that will do a really good job of controlling the cost of taxation. He's got some unique investments in oil and gas that we'll be able to use with proper positioning to offset some of the ordinary income events that are happening this year. He's got an oil and gas investment he made in equipment that has a big depreciation deduction, but it is useless unless you have income to offset that, so we're positioning that in his operating company where we have enough income to take advantage of that big depreciation write-off. So really, I call it moving the pieces on the tax chessboard in your favor rather than the IRS's favor. And he came to my office and we kind of went through this, and we're in the middle of the implementation process to his plan. And of course, he's a lot more complex than your average investor, but we're going to get some pretty good results.
Yeah, I actually, just to give you an idea, I went to that meeting and I've never done you've seen it all and think, whoosh, you know, I was just, inside my head, I'm jogging in place, as my dad would say, and my head was blown as far as thinking about all these strategies and how they can personally save me a ton of money. And especially with this year selling, 8 assets? So there's a lot of gains that are after the fact, which I made a huge mistake because I am trying to do that after the fact. But any final questions, any comments for Charlie? Wait, on the microphone, that's because so everybody else can hear.
So it was really informative. I appreciate you.
Thank you.
When are you all planning to do the follow-up longer meeting?
We'll talk about that in a minute.
Okay.
All right, thank you so much,
Thank
Charlie.
you very
I
much.
appreciate it.
Great to be here.
Oh, here. Charlie,
Are you gonna stick?
let me get your remote. There you go. Okay, first off, be honest, who's really confused? Okay, I'm not just a little confused, I'm really confused. Okay, I mean, because that's the honest part of it. I'm still trying to figure out how all this stuff works and how it integrates and how to use it. And part of that was, wait a minute, I put it in there, how do I get it back? You know, and there's a lot of that as far as, you know, thinking it's tied up and it's not there. I've got another friend who's looking at another structure and it goes in here and it's in this trust that he has access to, but technically he no longer owns it, but he's the beneficiary of the trust. And I'm like, I don't like that idea. There's so many of these things that could hurt that we want to make sure to avoid. And so you need to have a professional to do that. You know, like I said, I paid $10,000 for consulting, but what we were going to do with Charlie is I'm going to hire him to come back in and spend 3 hours and go in detail. And because we're hiring him to do that, we're going to do that and charge $1,000 a head for coming there for 3 hours in depth, in detail. And I'm assuming not everybody's going to want to come, but if you do, it's going to be $1,000. Reach out to Garrett or Julian and he can set that up. I don't know when that's going to be yet. We have not scheduled that. And getting on Charlie's calendar, you can imagine, is pretty dang tough. But if you're who would be interested in that? Go. Okay, good. Well, we will get that information out so that you have that as well. So let's see what's next. Okay. Who wants another investment opportunity? Okay. We've got 2 things. I'm going to start with 2. First off, Mercer Park Apartments. This is a deal in Arlington. I will tell you, it will be full tomorrow. Okay? We have a couple of co-GPs in this, and each one of us is only raising about $3 million. So we could fill it all up tomorrow with $9 million with everybody in here. And unfortunately, because I didn't find and source the deal, I couldn't take ultimate control. But we are going to raise $3 million from our side. Then we're going to give them 2 weeks to raise money. And then we're going to fill up the rest of it. So even if you can't get in right now, get on a waiting list, and you'll coordinate with Julian or Garrett for that. Okay? It's projected at about a 20% per year average annual return. It's in Arlington. We're buying it way below market. It's going to be a great deal, and they're starting to come around since we've been so slow on buying. The next one is a development property. Oh, by the way, Mercer Park, we're going to be closing in December. This is Iron Ranch. This is a different deal. We're going to build office industrial flex building. Anybody know what that is? With pride. And so we're building that, and our first project is in Fate, Texas, which is just on the other side of Rockwall. And they just built a new Freshens grocery store. There's supposed to be an H-E-B going in right there, and there's a major development that they just broke ground on right there as well, and it's on the frontage of I-30. What we're doing on this is we're going to have a 10% pref and then a split with the partners. Our projected returns, again, I underwrite conservatively, is about 22% average annual return with a year 3, 116% cash out refi. Who likes cash out refis? Yeah, I like them even better now, exactly, yes. And then you still have the carried interest. And we're going to be building these all over DFW. So that's the goal, is to get this one and have a branded product, which is going to be a lot of fun to go ahead and build and get started on. So we're closing on the land. We're going to be raising between $2 and $5 million right off the bat to close on the land and finish our architectural drawings and finish our bids. We've already got all the numbers in place. We've got a deep dive. I think, is it live? Not live on IMS yet. It's within this week, I think, right? Tomorrow? Mercer tonight, Iron Ranch this week. So you'll be able to see that information. Who would be interested in that? Anybody? Oh, just a few. Okay. Now, I did something fun. I actually wrote a book. This is fun. This is I actually started writing this book. I was teaching kids at church about money, and this whole thought process came to me, and I wrote that down, and that was about 15 years ago, 16 years ago. And finally got it done. I had a ghostwriter help me finish it, just so that I can sound smarter than I am, because you don't want to hear my writing. But if you want to go to read.gods-moneyflow.com, but you go there and sign up, and we'll give you a 30% discount off that for the day of buying it. And you can share that information as well. And there is a personal reason why I'm doing that. If I can get enough sales in that first day, then I can go to a bestseller level, and then add best-selling author on there just as another ego deal. So that's fun. So go ahead and go on to that site and register, and we'll give you a coupon for that. And of course, we'll send out more announcements, and that should come out in December.
Can I get it autographed?
You can. Personal autograph for you, Julian. Okay. All right, Brian.
I'm here.
Come on up.
Thank you, thank you. Julie, would you come up first just real quickly, please? Before we talk about that, I get the fun part of the night. But would you just, again, talk to them about Mercer Park, when it's going to be live, how they access it, how they get in touch with you, because Darwin's not exaggerating. This thing's going to be gone quickly, so you've got first shot at it.
They do?
Sure they do.
What happened to the other people that are already in? It will be live tomorrow morning. So I will tell you, the first thing you need to do is remember how to get into your IMS account, into the portal. I know I'll probably get 15 or 20. I forgot my password. So that happens. I forget mine, not for this particular portal, but yes. So if you don't have your password, quickly reach out to us and we'll get you a reset done. Go on to the portal and you'll be able to subscribe there. Very simple, very easy. What else did you want to tell them?
That's it. I just
Oh,
want
that's
to make
it?
sure they know how to get access
Okay.
to Mercer
Yep.
Park.
That's
New people.
Yeah, I'm going to do that. Okay. Before I get the fun part of the night. So, not that Charlie's not fun, because, gosh, what information that guy's got to share, right? I mean, my goodness. And I know just rooming here with Darwin in the office, hearing about what he's doing in Darwin's financial life is just awesome. So, not that wasn't fun. And Darwin, thank you for the new opportunities. And Julian, thank you for talking about how to access it. But I get the fun part of the night and talking about some successes of 2022. Before we do that, and we had a full schedule tonight, but I would like to see a show of hands of all those people if this is your first time here at a DGRE meeting. Please hold your hand up and keep it up, please. Just want to get an idea. Okay, great. Thank you. Who drove more than 30 miles? Who drove more than 50 miles? 31. There's a 31. There's a 50 back there. Yeah, there's a 50 back there. And again, huge thank you for being here. The reason I'm asking you to keep your hands up, I would really love to get a chance for some of our team members to meet you. And even more important than that, you hear me say this at every meeting if you've been here before, and most of you obviously have. Yes, I want to meet you. Julian wants to meet you. Darwin wants to meet you. Garrett wants to meet you. We all want to meet you. But I encourage you to reach out to your neighbor. Look who's sitting on your left, sitting on your right. Those are DGRE people who've been with us for a long time. Those are the ones you want to talk to, okay? Okay. So, again, thank you for being here. Having said that, Darwin mentioned a little while ago that we had 8 assets that we're selling in this year. That's certainly untold for us. I mean, that's just, you know, we didn't go into 2022 planning for that, but, you know, if you've been here part of the meetings, you know that the market kind of did some things, and we wanted to take advantage of our motto. Anybody tell me what our motto is here at DGRE? Who wants a prize? No, you're not eligible, Garrett, sorry. Somebody was starting to say it. Best interest of the partner. Okay? See me after the meeting for a prize. Anyway, what I'm just trying to say is the opportunity arose, we looked at them, and we're always making a decision based upon what's best interest of the partner. So, having said that, who was in Silver Creek? Okay? Show of hands, all those in Silver Creek. Okay. Little over $14 million distributed back to your partners on that investment. About a 65 total ROI for almost a 20% annual rate of return. You okay with 20%? You want more, right? I know. Sometimes we're a victim of our own success. Okay, just going in chronological order. Anybody in Gold Creek? Oh, wow, big part of the room. That's good because you all shared in us sending almost $22 million back to the investors. 184% total ROI or 78% annual rate of return. Congratulations, all of you. Congratulations. That's awesome. So, and by the way, both of those have now finished both distributions. So I'll go through this as we go. You've received your first and your final distribution on those. Okay, how many of you were in Village Oaks? Okay, not as many, but a few. Okay, still. Almost $4.5 million distributed back to the partners for 111% total ROI and a 63% ARR. Okay, I'll take that all day long. Okay, I'll take that all day long. Okay, who was in 2405 at Park Row? Reggie, stand up. This was Reggie's property. Was a co-sponsor. Great success story. So again, almost $2 million, $1.88 million distributed back to partners for 40.5% and almost 15% average annual rate of return. Congratulations, Reggie. Great job. Okay, who was in the Brazos? And when you got in it, it was Village Condos, but we changed it to the Brazos. Okay. A little over $7 million distributed, 71% and almost 44% annual rate of return. Like that. These have all sold this year. Okay. Any in Southwest? Anand, stand up, please. Take a bow. This was Anand's property. Okay. A little over $3.3 million, 71% ROI, almost 25% ARR. We okay with that? Okay. All right. Okay. Anybody in Ridgemar? Anybody here in Ridgemar? Okay. And Anand too. Okay. This wasn't the best of the properties, but you know what? Look at the I'm just asking you to look at the track record. 15% total ROI, a little over 3.5%. Again, wasn't a great success story, but we found a way to take a problem property that turned into a challenged property, I should say, and make sure you got your money plus some back. Okay? So still, I'm with you all the way. Okay, Amber Vista. Don't jump the gun here. It is not closed. It is not closed. But we do anticipate closing on December 7th. So who's in Amber Vista? Okay, these are best guess numbers today. You know, you still got prepayment penalties. You still got all kinds of things that you got to true up before on closing day. But these are our best numbers. And again, we try to be a little conservative here. But 100% total ROI, a little over almost 24% AR, average annual rate of return. Okay, happy with that? Okay. Wow. Darwin, I'm going to ask you not to sell 8 properties in 1 year again, if you don't mind. But, and again, we didn't plan that. But congratulations to all of you, okay? Because that's, again, great success, a lot of money coming back. And I would say that this slide is going to represent the total sum of those properties that DGRE has distributed back to its partners in 2022. Now, the figure I'm about to show you is just from sales proceeds of the properties. Has nothing to do with the monthly distributions. I did not add that in there. So if you're getting monthly distributions, it's on top of this. But somebody was running a total in their head as we were going through, right? $61,626,916 back to the DGRE partners through those 8 properties. So come on, one more big round of applause for all of you, all of you. And congratulations, that's just awesome. So I'm going to ask you, you better get in touch with Charlie. What are you going to do with that money? Okay? What are you going to do with that money? Before I move on to Q&A, I'm going to ask, okay, if you were in any of these properties, now this, I know I should have done my homework before we started this. If you were in any of these properties, I'm going to ask you real quick, if you would like to, please come up because we'd like to present a check to the group. I know there's probably more people that want to come up tonight, but come on. If you were in any one of those properties tonight that we just went through, I'm going to ask you to come up and take a big picture. All right, you're on that end. Right. Reinhardt, you're on that end. All right, there you go. Come on, we got lots of room back here in the back. Come on, don't be shy. Don't come this way, though. Go the other way. I don't want you to hit my computer, sorry. Come on, squeeze in. Act like you know each other. Act like you love each other. For $61 million, do you love each other? Come on. Come on. Come on. Don't be shy now. Don't be shy. Okay, again, another big congratulations. Okay, Q&A. And again, Darwin's here, Julian's here. Yes.
Sorry, guys, I'm kind of losing my... This is the time of the year where we're getting requests from those of you who have self-directed IRAs. How many in here have self-directed IRAs? You know what I'm talking about, right? They want evaluation of your account on a specific investment. Remember, we do not value your IRA investment. Well, all we can do is give you the basis or what your initial investment is as the value of the investment at any particular time other than when we sell the asset. Then it'll be valued by us. Otherwise, all we can do, if you put in $50,000, $100,000, that's all we can do. So just keep that in mind when your IRA custodian asks you for that form to be filled out.
Thank you, Julian. Okay, well, we've got the team here. Yes, Dillard, I'll go ahead and start Q&A. But now that we've got much of the team here, and this is the last time we're going to see you this year. We're really sad about that. But we're not going to have a meeting in December. We're going to hope you able to spend that time with your family and friends and enjoy the festivities of the season. And so tonight's kind of your last option or your last chance, at least live anyway, for Q&A. So it could be about anything and everything. Does not have to be about what we talked tonight. Again, Julian's here, Garrett's here, and our investor relations team. Dillard's here. He's our controller / accountant / money controller for the operations. Darwin's here, so I think we can answer any questions that you might have. So, but I would ask you again, please let us bring you a microphone if you don't mind. Garrett will be bumming around so that the people online, we've got about 200 people online as well as the 100 people that are in this room. So up here first, Garrett, right here.
Hi, this is my first time here. So let's say you make an investment. How many years do you expect it will take before you can get your money back and the 20%?
Okay. Great question. I am. And the 20%. Yeah, and the 20%. And the 20. Darwin, you want to take that? Because what Darwin's going to tell you is what we model a property to keep it. I'll let Darwin talk about it.
Okay, my mic should be okay. We budget 5 years. What we do is we do a plan for 5 years, but it usually doesn't go that long.
Yeah, I saw all the photographs here. It says 3 to 4 years.
Yeah, 3 to 4 years is a pretty good average, but we need to do that. We're looking at needing to hold longer to get better returns with how tight the market has gotten. So, but we plan on 5 years, and it depends where the market is, and we change. No guarantees, no. Yeah, absolutely.
One of the properties we talked about up here tonight, we actually had for 18 months. Another one we just had for about 27 months. But one we just did in last August, we have for 10 years. So it's kind of runs the gamut. Reinhardt, let me bring you the microphone, please.
But the other part of that is the cash out refinance. So what plays into that decision to do the cash out refinance?
We love cash out refinances. It's very sexy. Everybody loves it. They get a bunch of their money back tax free. I see a lot of smiles for those that do get that. Here's the thing, we plan on it. Right now, strategies have shifted. Okay, and a couple things. First off, you saw the lower return properties. You know what they had in common? They were smaller properties. Okay, it's too hard to absorb a lot of expense in the smaller properties, and that's what gets hit. So larger properties do better. That's one. Next thing is our strategy changes right now because if you want to get debt, it's like 55% loan to cost. Very low leverage. Now, that adds, there's spin to this. It's very low leverage, but it's very low risk because you've got so little debt. So the plan now is to find properties, especially that you can assume loans on. So we looked at one today and it had a 3.09% interest rate. 2.5 more years of IO, and 55% loan to cost. So we would need to raise a whole lot more money. And because we can't raise, I think it would be hard to raise $30 million a pop, we might use private equity. But on those, we look at, the strategy for me on that is we'll wait 2 years to 3 years and wait until the market turns back over, and at that time do a cash out refi and maybe pay off private equity or pay off partners so that they can get a benefit from that. That's a big part of the strategy shift right now, is buying those and plan on having cash out refis once we get the debt market all situated.
I'm coming.
So I was wondering if you could speak to the Mercer deal, as in where the interest rate would be, and then if there would be bonus depreciation this year included in that.
There will be bonus depreciation. We're estimating about 80%. And the interest rate we are assuming, Mercer Park, we're assuming the loan and it's at 3.84. It's about 3.84%. Again, don't hold me to that. I'm going off memory. We look at a lot of properties. And we've got 1 more year of IO left on that. And what's nice is we've got 9 years left on the loan. So we plan on going out 5 years, but in 3 years we can we can get a supplemental and pay off private equity that we're also getting for that.
What do you mean by IO?
Interest only. Interest only, so that you don't have an amortizing loan.
Is it locked at 3.9 for 9 years? Is it locked at 3.9?
Yes.
For 9 years?
Yep. Yeah, fixed. Yeah, Nikolai. Oh, wait.
And if you'd bear with me, I've got one more question
Sure.
for you. On the Iron Ranch, you mentioned a 10% preferred return.
Yeah.
Is that where you pay your partners 10%, and then after that, the split goes into the return that you're
Correct.
projecting?
A preferred return is the first, think of it like debt. The first 10% goes to the partners. Now, if we can't afford to pay it, it accrues. So if you put in $100,000, because this is new construction, first year you're not going to get paid the first year. So at the end of that year, your capital account goes from $100,000 to $110,000. Okay. Then the next year we'll be able to pay out that preferred return, the 10% on the larger amount on the 110, and then you also get a split of the cash flow.
So then does the preferred return come out pre-sponsor?
Preferred return comes out pre-split, yes.
Thank you.
Okay, Nikolai.
Hold on a second.
Yeah, so just want to follow up on
I just want to follow up on that Mercer deal. What are the terms of the private equity?
Private equity, I think it's 13% is how much they make per year. Preferred equity, just so that you guys know, think of it like debt, is pretty much what it is. It's a 13% interest loan. However, that's the amount that they get paid, but then there's a thing called a current pay, which means that's what we're paying on. So we have to pay 6% is our must pay. That's our debt service on that is 6%. Now the other 7% accrues and compounds on top of that. So they make a fixed 13% return. What private equity does is that either makes a good deal great or a bad deal horrible because you have to pay that amount. Okay, so if you're going to make over 13%, then the partners make more money. If we make less than 13%, we get hurt.
Is it the same private equity that was used in Oakview, I think?
Silver Creek.
Or Silver Creek.
Silver Creek and Gold Creek both use private equity.
Right.
And
Is it the same company?
And it's
New
the same
York-
company,
New
New
York
York
Trust
Mortgage
something?
Trust.
Oh, okay.
New York Mortgage Trust is who's providing that. We actually have a walkthrough with them on Monday.
I had two questions on Mercer Station. One is, are you guys being the property managers?
Yes.
And the second question is, who are the other GPs?
I don't want to disclose that right now, but they are, but just because we're broadcasting and recording it. But Julian can answer that question.
I just said they're industry professionals.
Yeah, they're not sponsors though.
And yeah, we're controlling the deal from start to finish and managing it. So.
It's all just like a co-sponsor, where a co-sponsor can do very little, like some of them, or a whole lot, like a non. They're going to be pretty much silent co-sponsors. We're in control of the whole thing. Dark Horse is the managing member, and we're in control of the whole thing.
Can you take 1031 money?
Can we take 1031 money? No. We need to figure out a way to do that, though. And there's some problems with how to do that that we haven't been able to overcome. We'll try and figure that out. Any other questions?
Any questions about anything?
Right. Oh, two more.
So when are we going to get more information on Iron Ranch, and whereabouts is it in Fate? Is it right off the highway in
Yes,
Fate?
if you're going east on 30, there's, is it a racetrack right there?
Yes, on the north side.
No, it's Lowe's. Yeah, Love's. The Love's, the very last exit for Rockwall.
Okay.
You get off on that exit
Okay.
and stay on the service road just past, there's a self-storage place
Okay.
and a vacant lot, and that's ours. And there should be a big sign going up there in the next couple weeks for pre-leasing on that.
Okay. When is it coming out on the website and everything else?
For Iron Ranch next week.
Okay.
And tomorrow, what?
Tomorrow Mercer Park comes out.
I had one more question about Iron Ranch right here.
Okay.
Can you said it was industrial flex office. Can you elaborate on exactly, is that just what that is, or?
It's cool. You've seen these and you've been in them, I'm sure. And what it does, it looks like retail with a garage door and an individual door. So they're individual spaces, and it's a big white box inside. So you can do any type of use. You can have, office space. You can have, part storage, part office. You can have, where you can pull cars in if you need to. It all depends on what your use is. And again, we're focusing on areas that are underserved by office, just like in Fate and Rockwall, because you don't want to go. Give you a prime example. The same product in South Lake, you can rent for about $12 per square foot, back behind things, kind of hidden. But there's so much space there, there's a lack of demand. There's so much space there that prices go down, okay, too much supply. Out in Fate, we're looking at over $20 per square foot because it's on the highway and because it's underserved, okay, and have you seen Garages of Texas or urban garages? It's a similar product to that, but those are condo models where they sell the condos. One of our partners on that, we're consultants on those two different product types. And so that's the same type of model we're using, but we're going to do it as leased product, and then we're going to have iron ranches all over DFW and then spread it out from there. Our goal is to build that real big, but each one is an individual LLC to invest in. So you'd be investing in just Fate for right now. When you get more, then we'd be doing more in the future.
Cool.
Any other questions?
Okay.
Oh.
Yep.
Is there a minimum requirement for the investment?
Our minimum is usually $50,000.
And I'm on visa, so can anybody can invest, like the H1?
He's on a visa. Do you know?
I don't think it'd be a problem, but we just run into the Foreign Investor Reporting Act.
Yeah.
But
Because we've had one lady from China who invested. So I mean, so there's a possibility.
Are investments only in $50,000 increments? Can you do like 75,000, or does it just?
It's a 50 minimum, so you can do 75, 100, 150, 10 million, whatever you want to do.
$25,000 blocks with a $50,000.
Yeah.
So $25,000.
Yeah,
Okay.
each share is 25.
Each share is 25,000. Yep. Okay. Well,
Well, I want to do one more thing.
Okay.
I started a small Facebook group, which is private, and I'm calling it the Young Guns group. And this is for kids or very inexperienced investors. And we're doing, just to give you an idea, we're doing a small flip house. And I don't need to have anybody in it. It's 100% financed by hard money. It's going to be a flip. We're going to make a bunch of money on it. But I'm opening that up for smaller investors that, they can put 5,000 in and things like that. So it's very small, and it's so that somebody that's new, these are like for the 20-somethings, okay, new investors, young, inexperienced, so that they can see how that's done. So we filmed the, actually, no, she's telling me no, don't point her out, don't point her out. But we have that for small investors, and we're filming all the different process of the whole thing so that people can see what they're doing. So if you're on Facebook, you have to do a friend request or whatever, and however all that works, and then I got to approve it, and I'm technically challenged, so I'm still trying to figure out how to do that. As a matter of fact, one of the videos is completely sideways the whole time. So that's how talented I am. Any other questions?
I just have a, excuse me, a follow-up. I always think of these things after someone's asked the question. Reinhard, you mentioned about the refi? Cash out refi. Well, if you've been around long enough, I know you have. I've known you way too many years. Yeah, I know. So.
You admit to it.
I know. But anyway, on our refis, that is usually baked into our spreadsheet, our model. It's usually on the third year. And because one of the reasons, the primary reason is we like to get into hybrid, which is value add along with some physical plant rehab, and it takes a while to get all this accomplished, and then get the units back online, get the NOI up, and then we can execute the refi. So that's always in that. And to piggyback on that, for those of you who've been emailing me, and I'm not upset with you, just kind of wholesale telling you, when we do these deep dish discounts, a la Lakeside, what used to be Bent Creek, since we're doing 20,000 plus a unit in rehab, that's a deep dish value add. So do not expect a distribution for at least a year on a play like that. So just keep that in mind. It takes a long time, particularly in light of all of the supply chain issues and the shortage of workers. Another thing that popped in my mind when someone was, I think it was Nikolai, you were talking about the private equity. Yeah, there are pros and cons to using private equity, preferred equity. The beauty of it is that it gives us additional bonus depreciations. So for those of you who need to have bonus depreciation, thank the participation of preferred equity.
And that's everybody who was in these properties tonight, by the way.
Yes.
Just to further expand on that, how that works is they don't participate. So if we have $10 million and we only have $5 million, $10 million in capital we need to raise, and $5 million in bonus depreciation, then that would only be a 50% bonus depreciation. But if we go out and get private equity for $5 million and our capital is $5 million, they don't participate in that. So we get $10 million. I said that wrong. $5 million. We're only raising $5 million, and we get $5 million in write-off, so it's 100%. So that's one of the other benefits of the private equity.
So what is the percentage of private equity in a Mercer Park?
What-
What percentage?
Oh, he wants to know what the percentage is of private equity on the equity stack.
On this equity, the total amount of capital I think is about 15 million, and we're going to get 6.5 million in private equity and about $9 million. These are rough numbers. About $9 million in capital. Okay. Did you have a question, Travis?
We'll repeat the question.
You would get 100% of the depreciation. That you get 100% of yours and also theirs, or is it?
Okay, the question, you want basically, I'll repeat the same thing that I just said, is, again, and I probably should say it a different way. Because if we have to raise $10 million and $5 million comes from private equity, we only have $5 million. If we have a $5 million deduction, rather than having that spread over $10 million, their $5 million doesn't count. So our $5 million gets 100% of it. And then, which is on Mercer like 80 cents on the dollar.
But to further expand on that, that is an example because each property is analyzed by the cost segregation people, and it may not be 100%. It may be 80%, maybe 70%, but it would be 100% of whatever the cost segregation study came back and gave us.
Okay. Any other questions before I close this out? Reggie.
On the Young Guns group, is that possible that I can put money in for my boys and let them be part of the Young Guns group?
As long as they are personally involved, because the whole idea is to train and teach them on the young gun side. Okay. Now, I'm going to go ahead and finish up with this. First and foremost, I want to go ahead and say there is a ton of work that goes into all this. And the one who works the hardest and makes sure that you guys make money the most is Brian Hawley. Please give him a round of applause. He absolutely works his butt off all the time and is brilliant and is doing a great job. And he is the one that actually, all of our projections and everything we do, then he has to go do it. It's a lot easier to do it on paper than it is to do it in real life. And between him and the whole management team, Vicky and Jessica and Zach and everybody else, they're all working real hard. And again, Julian is communicating with all the brokers and tracking down every property and also communicating with all the investors. And he is working day in and day night trying to find properties. Like I said, we look at 300 properties before we buy one usually. So give a round of applause and thank you for Julian for finding these deals. I forgot to introduce earlier Garrett. And Garrett's on our investor relations team. And he's the one that helps get all your paperwork done and everything in and is still learning the business. And it's my goal for him next year to be a sponsor himself, a co-sponsor with us on a small deal, so that he can learn that part, put him through the ringer on that part of it. So again, thank you so much for trusting us, being part of our life and being part of our investor team. And thank you so much. And you guys have a wonderful new year.
Yeah. Wait, before you guys go, just one last thing. None of what we do here would be possible without Darwin's vision. Yeah. So let's give it.
Thank you. Thank you so much. All right. Good night. Thank you.
Thank you.